Hello and welcome to the Development Context of Sovereign Credit Ratings, a podcast by UNDP and AfriCatalyst, where we explore the critical intersection of finance, policy, and development across Africa. My name is Maggie Motesi, and I'm always pleased to be your host. And today we'll be touching on a very different topic, which is focused on a question: is Africa overpaying for risk? And we'll be analyzing repricing the continent's creditworthiness in a shifting global landscape. We have talked about the cost of capital, which until now remains one of the most critical barriers to Africa's development. But at the heart of this challenge lies the sovereign risk premium, which is, in simple terms, the extra return that investors demand to lend money to a government or a sovereign state in this case. Now, this premium is not only shaped by economic fundamentals, but also by perceptions and perceived biases and how risk is assessed. And these are some of the conversations we've had in some of our previous episodes where we've looked at what methodologies are being used or how countries can really provide data to make sure the risk is accurate. And again, I don't know if this exists, and this is why we keep having these conversations. Now, this brings us to our urgent question: whether African countries are truly that risky, or are they simply overcharged, or is it a question of us really missing, some steps and, not being able to link that with the credit rating agencies, and what can we do to overcome some of these challenges? And to unpack this, I'm joined by Veronicah Kalema, who is the Group Head of Country and Sovereign Risk at Ecobank, and also a Concilium advisor to the Africa Credit Ratings Initiative. We hope to draw from her experiences and expertise on understanding sovereign risk assessments. Of course, she's also previously worked with Fitch Ratings. Veronica, thank you so much for joining us.
Thank you, Maggie.
Thank you so much. I just wanted to highlight as well that this podcast is part of the Africa Credit Ratings Initiative, where we're really advocating and also trying as much as possible to engage with countries and support them navigate credit ratings and access affordable financing. I just want to kick off with this question, Veronica. And I know that you've been part of most of these engagements with the Credit Ratings Initiative, including one where you are in Kenya at the moment. In your view, what portion of Africa's sovereign risk premium is really truly economic? And how much reputation and how much of it is reputation or perception driven?
To be honest, I wouldn't know what percentage is what, but I really wouldn't know. However, ordinarily risk premium above US Treasuries is driven by the sovereign credit fundamentals or the sovereign credit rating, the tenor of the Eurobond or the instrument that is that's being issued, and the liquidity of that instrument of the Eurobond. But there has been research by the IMF and others that shows that taking into account the rating level, the tenor, and the liquidity of the Eurobond, comparing it with, let's say, another country, an African Eurobond with the rating as another emerging market Eurobond for another emerging market, the same tenor and liquidity, there is an African premium. And this holds not just for Eurobonds, but other cross-border transactions, such as trade finance.
Yeah. So which means the factors that are really considered within their aspect. But from your own experience and working, for example, at Fish, if you don't mind, if we look back, what are some of the systematic issues you foresee and maybe urgent reforms that are needed within the global credit rating ecosystem?
Okay, so basically a sovereign credit assessment takes into account quantitative factors and qualitative factors, right? And the quantitative factors are data-based. They are the national accounts. These are numbers that, everyone knows and uses, inflation, et cetera. And some of them are then transformed into other metrics. But, all those are based on the data and they're measured and then they're weighted, etc. But the qualitative measures, that's where it becomes subjective, as they're not quantifiable. There are things like the level of regional geopolitical risk, the institutional strengths, and all these are measured, by the way, by the rating agencies, just to find out the risk of a country not repaying its debt, for example, if there's a war. Because if there's a war, in a place like, let's say, for example, a place like Sudan right now, of course, they can't repay their debt. So basically, that's what the credit rating agency is trying to find out. And what I'm saying is that this whole area is where it's gray. They're just trying to make sure, is the government willing to repay its debt, even if a previous government took on the debt and wasted the debt, is the new government willing to repay? So those are the kind of the soft issues that's where the perceptions come in. That's where African countries need to take control of the narrative. They need to explain political risk as it pertains to their countries. They need to explain regional political risk or geopolitical risk as it pertains to their countries. They need to explain institutional strengths and challenges and what they're trying to do about the challenges. So that's where the narrative comes in. They need to tell the country's story and get the rating agencies to understand what's really going on in the country. So I think that's where there is the perception. And, they always say that perceptions are very difficult to change. So it's just like you need to keep on engaging with people. Another thing, though, is that our economies are structured very differently from economies in advanced countries. So the explanation is longer. You've got to explain a lot of things because most of the advanced countries are where these ratings, rating agencies are based. The economies are structured differently. And so you need to explain how things run and how things structured. And yet, with an eye to the government repaying its debt. Yeah.
Yeah. Veronica, I'm sitting here thinking, well, I'm a journalist and we keep saying we need to change our narrative. We need to tell our story, which is absolutely true. But sometimes I'm assuming, we're now speaking to like government officials in the Bureau of Statistics, in the, Minister of Finance, and we're telling them you need to really engage, you need to tell your narrative, you need to explain this. I'm just thinking out loud. I'm saying they would probably ask me, what do we do? Do we go to the media? Do we just give us an idea of how this would really look like in terms of research?
Reforming. Okay. In a country like Kenya, they probably have sufficient data, so the first thing they need to do is, but ratings is a specialized skill, so you need to understand its focus and it's specialized. So what they need to do is start off by strengthening their understanding in how the data is used. So how is this data used? Strengthen your understanding, right? So when it comes to ratings, this is why they want the data. Then you use the data to support the narrative to the rating agencies and to everyone else, to the media, to everybody else, to the parliament. It starts off with the cabinet, to parliament, to you use the data to support the narrative. You ensure that the rating agencies get regular publications because in a place like Kenya, they do have monthlies from the CBK, they have quarterlies of the fiscal. So they do have this data. So they ensure that the rating agencies get it. And there's also needs to be a coordinated effort between the government agencies, which are not just the Treasury and the Ministry of Finance, it's the judiciary, ensuring that how do you deal with contracts? Are they respected? And also things like internal security within the country. For example, Kenya had protests. So you need to bring all these stakeholders onto the table to deliver the narrative, so that the rating agencies understand that this is a proper country that is run with institutions that talk to each other and that have a plan, a strategy, etc.
I mean, I really like how you touch on coordinated efforts. I mean, internally, when you think of credit ratings, you're just thinking, okay, the Bureau of Statistics can handle that. The Ministry of Finance can handle that. But it's like the entire government, parliament, everyone should really be part of this reshaping of the narrative. When you were speaking earlier about the narrative, a part of me was thinking about, we've seen growing concern around methodologies, and one of the key areas highlighted has been where the data doesn't capture enough the story, and obviously the question of data is still one that we struggle with across the continent, not even just for credit ratings, but also in very many other aspects where, you say, the agencies say we don't have enough data, or this is what the government could provide to us, and etc. let's say I'm a country like Rwanda or Uganda sitting there. How do you approach something like this?
I think, Rwanda and Uganda also have pretty reasonable data. It's explaining the data. Basically, the Ministry of Bureau of Statistics collects its data and consolidates it. So when you get data, it's in a consolidated form, but they know the underlying data that goes into that consolidated form. So if there is something interesting within that data, they should be able to explain that actually the main driver is technology or M-Pesa or whatever it is. So you're not going to get data at the frequency that you're going to in America or the US or the UK, etc. You're not going to get that level of frequency, but you are going to get you are going to get it in many countries. I'm not saying most, but in many countries, you're going to get it at the same level of frequency as in other emerging markets. That's why the statistical office is important, because they're the ones who compile all that data. They know what's going into the aggregated data that we see. Yeah.
I also have to really acknowledge, and even to our listeners, that we've made really progress. I think we've come along also with the Africa Credit Ratings Initiative, also Veronicah being part of the Concilium of advisors, from engaging with agencies, governments, and etc. We've made some significant strides in the past, also engaging with countries. And I saw recently Guinea got its first rating, Veronicah, which is really good news. But I wanted to, based on that, and also say, do you think at this particular moment where we're seeing some momentum growing and, countries like you and I chatted earlier, like Kenya, being really excited and wanting to make some reforms within the credit rating systems, do you think the financial markets are starting to recognize and reward this progress that the countries are making in managing, their economies? Or do you see some bit of changes in the coming moments? Yeah.
Okay. So far, the financial markets. Okay, let me just explain something about the financial markets. So, in terms of Eurobonds, where you see the sentiment on Africa just after the Trump tariffs, they spiked, but now they've all come down from their peaks, right? So, I think it's more about what's going on globally than what's going on in individual countries at the moment, right? But obviously, one of Kenya's ratings by Standard & Poor's has been improved to a B, and that is something that the financial markets are noticing. And when the others improve as well, that will be noticed even more. So I think most of the improvement is due to global sentiment. But, there are some improvements, as we can see, because Kenya's ratings improved to B in August.
On those just coming back to the markets, Veronicah?
The ones that are coming back to the market, they're coming back because the yields are falling. So it's like if a country had to go and borrow and refinance or borrow in April, it would have had to pay 400 basis points more than it is now. If an African country, on average, I'm saying on average. So basically, global sentiment has improved as people got over the initial Trump shock, and the impact of the shock hasn't, they've digested the impact of the shock, and then, then also I think also because the US currency is weak, so that makes emerging market assets a bit more attractive, and then US interest rates are falling, so that also helps emerging market yields. So it's a number of factors, but I think right now it's more geopolitical than actual improvements or actual progress on the ratings.
Would you say, and I hypothetically asking, are there like in such moments, is it like opportunities to take advantage of? Are there lessons to draw from? What can we walk away with?
For example, recently, I think it was last week, Kenya went in and refinanced did a bond sale and buy it back. So it sold, it issued a bond and then bought back a bond, a Eurobond that was going to be paid in February. And that was a liability management operation. So that's actually supporting its rating, because now no one is worried about Kenya not being able to pay off the debt in February next year, right? It took advantage of lower rates and went in there and issued a bond, paid off its bond a bit early, right?
Taking advantage of the opportunity.
Yeah.
Yeah. Okay. Kenya seems to be, taking really progressive steps, but again, I just don't want to say they are. I mean, it's also efforts everywhere. But I wanted to touch on something very critical, Veronica. How important is it for countries to establish dedicated credit rating committees or data units, as we've seen in Kenya and Ghana, but also looking at, for example, what we're looking um, at the workshop, the Interagency Credit Rating Committee for Kenya, are these like very important units that countries should consider having, specifically focused on that, beyond just having the ministries and statistics bureaus?
Okay, so yeah, it does. I mean, it does help. It allows for better interagency and private sector coordination. I think we've spoken about that. It allows for a strategic and intentional approach to dealing with rating agencies. So you have the data, so explain it, and explain it in a coordinated manner so that everyone, I'm not saying you have to rehearse everything, but so that, what the Ministry of Finance is saying is not opposite from what the central bank is saying. That doesn't tend to happen anyway, but with an interagency approach, it certainly won't happen. Everyone will know what is going on with all the other agencies, and even the private sector, they'll know what's going on with the private sector because the private sector would also be involved. So the private sector has complaints, they'll know about them. So if the private sector has complaints and the government and they told the government, they know what, how the government is addressing their complaints. So they can all be on the same page. They can say, well, we have these challenges, but this is what the government is doing. That is one of the things that is really good. It's better for messaging. It's better for proactive engagements because if you don't have, if you're not all coordinated, if there's a shock to your economy, then who is the designated person to speak to the rating agencies and explain to them, what's happening and what the government is doing. So this also helps in terms of that kind of coordination for if there's a shock in the economy. And then more importantly, it also builds better relationships with the rating agencies and better information flow to the point where, there's a problem in your country, even before the rating agencies call them, you've sent them a message saying, well, this is what the government is doing about it. Yeah.
Oh, that would be really nice because it's proactively thinking over and I think it would really solve a whole lot. Probably also providing them with some of that information, other than them really looking for that information from the governments.
Yeah, it's better. It's better if the government provides it. Yeah.
Yeah, I think it's a good thing. I really want to end our discussion with this point, Veronica, and it's really nice that we're speaking to you. We've had the Africa Credit Ratings Initiative, but we also have the Africa Credit Ratings Agency. Earlier on, you were touching about, how regional coordination is also really great. As we finalize the episode, maybe you could speak to us on how you foresee the future and what role really these regional initiatives could play, especially the Africa Credit Ratings Agency.
Okay. The credit. Okay. I'm not sure what the Africa Credit Rating Agency is good. I think they want to set up a credit rating agency, which is fine, and why they want to do that is they have noticed that noticed that the fact that a lot of African companies that are profitable, doing well, are not rated, or and that's because the ratings of the sovereign are low, right? When the sovereign rating of global ratings of the sovereign are low, they're single B. Meanwhile, also the size of the entities are relatively small, so they really can't sort of issue on the external markets. Meanwhile, most of their funding that is required is local, so they need Ugandan companies need UGX and to grow, to expand, etc., etc. So I think they see that gap, and so they want to set up a rating agency where they use a national rating scale, which is in local currency, and which uses the full rating scale. So like the sovereign, which will be the government, let's say Uganda or Kenya, would be a triple A, and then all the other entities in that country are given relative assessments, relative ratings within that country, right? So this what this does, it gives the level of differentiation. It gives a clearer view of relative credit strength, and it showcases credit-worthy companies, right, with lower default risks than what their sovereign international rating might suggest. So the whole idea is to open up this local currency ratings and attracting local capital to local entities, and the transparency, the ratings, and everything helps lower the cost of borrowing, because once you de-risk, the rating helps de-risk a company. So it actually shows this is actually the actual risk. So that helps de-risk the transparency.
Right.
And then that lowers the cost of borrowing for that company. And, so that's the whole idea. The whole idea is to promote this national rating so that they can attract the pool, so that it provides a home for pools of local capital. I think that's what they're trying to do. So that's what they're trying to do. And they need. Yes, there's a number of things that they need to do before that happens, but I think that's what they want to do. Already, there's some local rating agencies in Africa. I think there's about 10 or so already. But they're not in all of the African countries. So some of them are regional, right? Like in East Africa, you have regional Bloomfield, and some of them, like GCR, are in a number of African countries, and they have a much wider reach, and some of them are just in one country. So, but
Yeah, I think one of the things they also said they wanted to do was also provide technical and support capacity to countries. Again, we'll figure out as we move along. But thank you so much, Veronicah, for having time to speak to us today. Key takeaway from you is really, when we talk about shaping the narrative, it's not just about stories, but also the data, which I think is really something we need to know. We need to tell the narrative of our data. I'm not sure. I feel like for me, that's the key takeaway from our conversation today. And thank you so much for making the time. It was really nice to have you.
Yes, my pleasure.
Yeah, thank you so much. To our listeners, thank you so much for joining us on this episode of the Development Context of Sovereign Credit Ratings. You can find the podcast on Spotify and YouTube. It's also part of the Africa Credit Ratings Initiative, a partnership between UNDP-AfriCatalyst and partners in helping African countries strengthen their engagement to credit rating agencies and unlock affordable financing. Thanks for tuning in. Until next time.